The Intelligent Investor by Benjamin Graham is a classic investment guide that provides timeless principles for successful investing. Originally published in 1949, the book is considered a cornerstone in the field of value investing. Graham, often referred to as the father of value investing, shares his insights on building a rational and disciplined approach to investing that prioritizes long-term success over short-term speculation. Here's a brief summary of each chapter. Chapter 1. Investment versus speculation. Graham distinguishes between investment and speculation. He defines an investment as an operation that promises safety of principal and a satisfactory return, while speculation involves making guesses about the future market movements. Chapter 2. The Investor and Inflation. Graham discusses the impact of inflation on investments and advises investors to consider its effects when making long-term investment decisions. He emphasizes the importance of protecting purchasing power. Chapter 3. A Century of Stock Market History. The level of stock prices in early 1972. Graham analyzes the historical level of stock prices up to 1972, emphasizing the need for investors to be aware of market trends and valuations. He introduces the concept of the earnings yield as a valuation metric. Chapter 4. General Portfolio Policy. The Defensive Investor. Graham introduces the defensive investor, who prioritizes capital preservation over higher returns. He discusses the principles of asset allocation, diversification, and the importance of a margin of safety in stock selection. Chapter 5. The Defensive Investor and Common Stocks. Graham provides guidelines for defensive investors when selecting common stocks, including a focus on large, well-established companies with a history of consistent dividends and earnings. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. This chapter is directed towards enterprising investors who are willing to put in more effort and accept higher risks. Graham discusses the importance of analysis, introduces the concept of quantitative criteria, and advocates for a negative approach to eliminate unsuitable stocks. Chapter 7. Portfolio Policy for the Enterprising Investor. The Positive Side. Graham continues to guide enterprising investors, emphasizing the need for a positive approach by actively seeking out and analyzing potentially profitable opportunities. He discusses various investment strategies and the importance of understanding the business cycle. Chapter 8. The Investor and Market Fluctuations. Graham addresses the inevitability of market fluctuations and advises investors to remain rational and disciplined during periods of volatility. He introduces the concept of Mr. Market, an allegorical figure representing market mood swings. Chapter 9. Investing in Investment Funds. Graham discusses the pros and cons of investing in investment funds, including mutual funds. He provides guidance on selecting funds and highlights the importance of understanding the fees and expenses associated with them. Chapter 10. The Investor and His Advisors. Graham explores the role of investment advisors and provides criteria for investors to consider when selecting and working with financial professionals. He emphasizes the importance of maintaining an active role in decision-making. Chapter 11. Security Analysis for the Lay Investor. General Approach. Graham introduces the concept of security analysis for individual stock selection. He provides a general approach to analyzing stocks, including an emphasis on financial statements, earnings, and the overall financial health of a company. Chapter 12. Things to consider about per-share earnings. Graham delves into the nuances of per-share earnings and cautions investors about potential pitfalls and misinterpretations related to this metric. He emphasizes the need for a comprehensive analysis of a company's financial statements. Chapter 13. A comparison of 4 listed companies. Graham conducts a detailed analysis and comparison of 4 companies to illustrate the principles of security analysis. He emphasizes the importance of thorough research and understanding the underlying business. Chapter 14. Stock Selection for the Defensive Investor. Graham provides specific criteria for defensive investors when selecting individual stocks. He advises a conservative approach, focusing on companies with a history of stability, consistent dividends, and a strong financial position. Chapter 15. Stock Selection for the Enterprising Investor. Building on the previous chapter, Graham offers additional criteria for enterprising investors. He discusses various quantitative and qualitative factors to consider when seeking out potentially profitable opportunities. Chapter 16. Convertible Issues and Warrants. Graham discusses convertible securities and warrants, providing insights into their characteristics and potential advantages. He advises caution and thorough analysis when considering these investment instruments. Chapter 17. For extremely instructive case histories. Graham examines 4 historical case studies to illustrate important investment lessons. These case studies provide real-world examples of successes and failures in the market. Chapter 18. Investment versus speculation. Results to be expected by the intelligent investor. Graham revisits the distinction between investment and speculation, emphasizing the need for a disciplined and rational approach. He discusses the expected results for intelligent investors who adhere to sound principles. Chapter 19. Adequate portfolio versus diversification. Graham explores the balance between an adequate portfolio and the concept of diversification. He advises against excessive diversification and emphasizes the importance of thorough analysis for each investment. Chapter 20. Margin of safety as the central concept of investment. Graham concludes the book by reiterating the central concept of a margin of safety. He emphasizes the importance of buying securities at a significant discount to their intrinsic value to protect against unforeseen risks. The Intelligent Investor remains a timeless guide for investors, offering valuable insights and principles that continue to be relevant in navigating the dynamic world of investing. Let us review the key concepts from The Intelligent Investor. Margin of safety. Graham emphasizes the importance of a margin of safety, which involves buying securities at a significant discount to their intrinsic value. This provides a buffer against unforeseen events and market fluctuations. Investment versus speculation. Graham distinguishes between investing and speculation. He defines an investor as one who analyzes and selects securities based on thorough research and a long-term perspective. Speculation, on the other hand, involves making bets on short-term market movements without adequate analysis. Mr. Market analogy. Graham introduces the concept of Mr. Market, an imaginary person who offers to buy or sell stocks each day. The key is to take advantage of Mr. Market's occasional irrationality by buying when prices are low and selling when they are high. Defensive versus enterprising investors. Graham categorizes investors into 2 types, defensive and enterprising. Defensive investors are more conservative and prioritize capital preservation, while enterprising investors are willing to undertake more research and accept higher risks for potentially higher returns. The 3 principles of intelligent investing. Graham outlines 3 principles for intelligent investing. Develop a sound investment policy, stick to it with discipline, avoid succumbing to the emotions of the market. Understanding financial statements. Graham stresses the importance of analyzing a company's financial statements to assess its financial health. He recommends focusing on factors like earnings, dividends, and stability over time. Market fluctuations. Graham addresses the inevitability of market fluctuations and advises investors to remain calm and rational during periods of volatility. He emphasizes that market prices are influenced by emotions and speculative activities, rather than intrinsic value. Dollar-cost averaging. Graham introduces the concept of dollar-cost averaging, where investors regularly invest a fixed amount of money, regardless of market conditions. This strategy helps mitigate the impact of market volatility and reduces the risk of making poor investment decisions based on short-term fluctuations. Investment bonds. Graham discusses the role of bonds in an investment portfolio, advocating for a conservative approach with a focus on high-quality, investment-grade bonds. He explains the relationship between interest rates and bond prices. Dividend policy. Graham suggests that investors should favor companies with a consistent and conservative dividend policy. Dividends provide a tangible return on investment and can be a sign of a company's financial strength. Graham's stock selection criteria. Graham outlines specific criteria for selecting individual stocks, including a history of earnings growth, a strong financial position, and a reasonable price in relation to earnings. Intrinsic value. Graham introduces the concept of intrinsic value, which represents the true worth of a security based on fundamental analysis. He emphasizes the importance of estimating intrinsic value to make informed investment decisions. In conclusion, The Intelligent Investor by Benjamin Graham provides a comprehensive and enduring guide to intelligent investing. Graham's principles, including the importance of a margin of safety, distinguishing between investment and speculation, and focusing on long-term fundamentals, continue to be relevant for investors today. The book emphasizes the need for discipline, rationality, and a thorough understanding of financial statements to navigate the complexities of the market successfully. By following these principles, investors can build a solid foundation for long-term financial success and weather the inevitable fluctuations of the market.
Please let us know you want more content like this by liking, subscribing, and sharing. Don't forget to hit the notification button so you don't miss a single post.